Hey everyone, and welcome to today's deep dive. I am absolutely thrilled you're tuning in because today we are going to completely dismantle and examine exactly how banks actually operate. We all interact with them every single day, right? Yet the inner workings of this massive industry remain a total mystery to most people. So we're going to strip away the polished marble floors and the fancy lobbies to look at the raw, unfiltered economics of bank ownership. If you've ever wondered how these institutions generate such astronomical wealth, well, you are definitely in the right place. Okay, let's dive right into this because this is the ultimate financial hook. Is the modern banking system just a perfectly legalized scam? Now, I know that sounds intense, but we really need to shatter this deeply ingrained illusion that a bank is just a static, safe vault sitting there guarding your cash. I mean, have you ever wondered why billionaires and massively wealthy investors are so desperate to acquire banking licenses? It's definitely not because they want to offer you great customer service. It's because owning a bank is arguably the only legal business model in the world where you can construct an absolute empire entirely using other people's money. To understand how they pull this off, I want you to picture a really relatable scenario. Imagine you walk into a beautifully air-conditioned bank branch and you confidently deposit 10,000 rupees at the teller counter. You hear the crisp sound of the notes being counted, or maybe you just see the digital numbers pop up on your banking app and you walk out feeling totally secure. In your mind, that 10,000 rupees is safely locked away in a giant steel vault with your name on it, just resting there, safely earning you a tiny, predictable 3% to 4% interest over the year. It feels safe, right? Well, actually, that comforting image is an absolute illusion. So let's get into Section 1, the money multiplier effect, which is also known as fractional reserve banking. We're going to peel back the first layer of the onion here because the shocking reality of what actually happens to your $10,000 the exact moment it crosses that teller counter, that is where the real money-making begins. Legally, the bank does not have to keep all of your cash in the vault. In fact, they are only required to keep a tiny, tiny fraction on hand, usually around 10% as a reserve. So what happens to the other 90%? The bank immediately hands it right out the back door to someone else. They take your money and instantly loan it out to people buying homes, buying cars, or funding their businesses. Your money isn't resting at all. It is immediately put to work for the bank. And this brilliantly illustrates the true genius of their business model. For the privilege of holding your deposits, the bank pays you a very modest 3% interest. But using that exact same money, your money, they turn around and charge borrowers anywhere from 10% to 12% in loan interest. The contrast is just staggering. You get a tiny sliver while the bank takes a massive double-digit cut using the very cash you trusted them to hold. In the financial world, that massive gap is officially known as the net interest margin, or simply the spread. You really need to remember this term because this spread is the bank's first and absolutely biggest profit pillar. It's the core engine of their wealth creation. They are literally pulling profits out of thin air by acting as a highly efficient middleman. They pay you pennies, they charge borrowers dollars, and they keep that lucrative gap right in the middle. It is the ultimate proof that bank owners build their immense wealth directly off the backs of your deposits. All right, moving on to Section 2, the non-interest revenue engine, or as I like to call it, the hidden fees. Because, you see, the appetite of a bank owner isn't satisfied just by playing the interest rate game. No way. They have a whole second layer to their profit machine designed to drain wealth straight out of your account, bit by bit. First, you have the hidden charges, those pesky ATM fees, the brutal penalties for dropping below a minimum balance, or even fees just to send you an SMS alert about your own money. Second, they act as a sales floor, constantly pushing third-party products like mutual funds or insurance policies entirely for hefty commissions. And third, the silent killer, interchange fees. Every single time you happily swipe your debit or credit card at a local shop, the bank swoops in and takes a 1% to 3% cut from the merchant's revenue. So the crucial point here is that whether you actively use the bank's services or just let your money sit there, they are systematically, relentlessly extracting wealth from you. Let's move to Section 3, the risk of bank runs. This is the ultimate threat. Up until now, this business model probably sounds effortlessly brilliant, right? But underneath this highly leveraged machine lies a terrifying systemic vulnerability, the bank run. Remember earlier when we talked about how 90% of all deposited money is immediately loaned out? Well, that means the bank physically does not have the cash on hand to pay everyone back at once. If a simple rumor starts spreading the bank is in trouble, a mass panic ensues. If too many customers run to the bank on the exact same day to withdraw their money, the bank literally runs out of physical cash. The vault will be empty. And listen, this isn't just theoretical fear-mongering. This terrifying theory grounds itself in stark reality over and over again throughout history. Just look at the recent collapse of Silicon Valley Bank. Here was a modern giant, an institution managing billions of dollars, and it was completely obliterated. It collapsed like a fragile house of cards in a matter of mere hours, entirely driven by customer panic. One day they are a titan of finance, and the next day, completely insolvent. All because the illusion of the full vault was shattered.
Which brings us to our final revelation, Section 4, Too Big to Fail and Government Protection.
You have to ask yourself, if this system is so wildly risky and built on such a precarious foundation of leveraged cash, why on earth do governments and regulators actively protect it? Well, it's because banks are the backbone of the economy. A bank owner sits in a position of ultimate power because their loans fund the growth of the entire country, infrastructure, businesses, housing, you name it. Because they are woven into the very spine of the economy, governments are forced to act as the ultimate safety net. When massive banks crash, the government rushes in with bailout money to rescue them, because letting them fail would literally drag the entire country down with them.
So I want to leave you with this deeply provocative thought today. The next time you open your banking app and look at your balance, ask yourself, is that really your money sitting safely in a vault? Or is your hard-earned cash just the raw fuel powering someone else's massive financial empire? It completely shifts how you view the financial world, doesn't it? If you found this explainer eye-opening and you want to keep dismantling the complex business models that run our world, make sure you like this explainer and hit subscribe so you never miss our next deep dive. Thanks so much for learning with me today, and I'll see you in the next one.